Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Anthony Nizzi. Good day to you, sir.
Hey, good day to you, Scott.
Thank you for coming in here today.
It's really good to be here.
You know, at first we were talking about doing this virtual, although we always prefer doing in person. And you were steward enough to say, you know what? Let's not do this virtually. Let's get together in person and do it right.
You know, anytime I can come down here and see you in Dallas, I'd love it.
Sincerely, thank you for being here. Today's topic, what are we going to be talking about today?
Well, we're going to be talking about a little behavioral finance, one of my favorite topics to cover.
Wonderful. Before we do that, let's do you the proper introduction. You are the Regional Vice President, correct?
That's right.
With?
Guarantee Income Life Insurance.
An amazing insurance company that we are so happy to represent. No, but seriously, tell us a little about yourself, where you came from, what your role currently is today, and then we can dive into a little bit about behavioral finance, which is a topic that you just said you're near and dear, but you're also traveling the country, giving this and delivering this topic, or I should say presenting on this topic to advisors, wealth managers all across the country. So I'm glad we have the time to unpack it a little bit.
Yeah. So I started in the industry back in 2006. I was on an index annuity sales desk with a company known as ING. I spent 15 years with ING and then Voya, and I held a variety of positions with the company there. And 2 years ago, I had the opportunity to join Guarantee Income Life as the regional vice president for their index annuity products. And it's been a wonderful transition. And Guarantee Income Life is a company that's been around for a really long time. Been around since 1926, based out of Baton Rouge, Louisiana. But it's a company that's really growing and making its footprint here in this industry, and it's really important and it's fun to be a part of. That's
fantastic. So it's a little plug here. Stay tuned. And Anthony and I will be doing a short episode on specifically a product solution and talking a little bit more, diving into the weeds, if you will, of Guarantee Income Life and some of their subsets and product solutions that they offer. So stay tuned. Moving on from there. So you started at ING in 2006?
Yeah.
Trugging along just nice until when? 2008. Then
That's right.
Hammer dropped on all of us. That had to have been wild.
It really was a wild time. And it to me, it's when this topic, behavioral finance, really it's been around for a long time, but it really took some roots at that time in 2008. And just kind of watching people make the decisions that they make with their retirement dollars. I think behavioral finance in and of itself is, Mike Tyson said it once when he said everyone has a plan until they get punched in the mouth. Mm-hmm. And how are you going to act? How are you going to behave when faced with adversity? Mm-hmm. And that's what 2008 really did to us.
I mean, 2008 exposed all of our vulnerabilities.
That's right.
I mean, the clothes were off, everyone's naked, and you're there standing with what you got. And it was a pretty challenging time, especially in the insurance world and financial services. I mean, in every market, but in particular, a lot of things were exposed, and we navigated through that period of time to only be stronger, and here we are today. And man, when have annuities been better than today?
Right. Well, and if we look at what came after 2008, right? You're talking one of the greatest bull market runs in history, and how people's perceptions change, the decisions that they make change from the beginning of that bull market run to the end of that bull market run. Mm-hmm. And people looked at retirement or their behavior with investing a lot different in maybe the beginning of that bull market run in 2009 than what they did at the end of 2020 or 2021. The euphoria at the end of 2020, beginning of 2021 was unlike anything that I've ever had a chance to experience in my lifetime.
Right. Yeah. It's an interesting, very, very good point. And that's the word I was thinking of, just how euphoric it was, and really how people's kind of mental acuity and the awareness of what should the expectations just got completely out of alignment.
That's right.
And fear greed took over, and nothing could go wrong with as aggressive or whatever the plan is. Everything's going right until it's not, until you get punched in the mouth. And here we are. And then you are in the doldrums of despair, and fear sets in. And those are the challenging times of when you probably aren't the best person to be making financial decisions for yourself. So let's take a step back and let's enlighten everybody on the literal definition of behavioral. So what is behavioral finance? Because anecdotally, you kind of hear a lot of descriptions of what this is. I think you can argue that for some advisors, or in some way, a little bit of is this a fad? Is this the newest topic of the day? But you made a great point. No, behavioral finance has been around for a very long time. The question becomes how many advisors actually invest in gaining the knowledge and perspective to better understand it, without it just being, it's what I'm supposed to be knowing today.
Right. Well, I mean, so the literal dictionary definition of behavioral finance is the study of psychology on investors, right? Why we make the decisions that we make with our retirement dollars or our investment dollars. The way I like to unpack behavioral finance is, I always lead off every presentation with a story. And it's the same story every time. I tell the audience that I'm driving across country from New York to Los Angeles. And I'm in New York and I'm stuck in traffic for 10 minutes. All of a sudden I see somebody zip by me on a bicycle. 10 minutes later, I'm still in the same spot, but that person on the bicycle is 2 miles up the road. So what do? Well, I immediately sell my car, I buy a bicycle, and I continue my trek from New York to Los Angeles. And I always ask the audience, does that make any sense at all? And of course it doesn't, right? But those are the decisions that people make every single day with their retirement dollars, right? We make decisions that are going to impact us long-term because of short-term market conditions.
Mm-hmm. Yeah, it's interesting because I dealt with a client just the other day, actually, who last year responded out of fear and concern, rightfully so. He's amassed a considerable amount of wealth, but a young and successful individual, and reading the headlines, hearing the news, absorbing the sound around him, right, which was not positive, and repositioned everything considerably conservative. And now he is looking back and this is the other disconnect, right? It's like, well, the market's done so great. Why isn't my account reflecting those results? Well, the market is also a very broad term that people loosely throw around. And they think just because the Magnificent Seven are up, then everything, it's this broad brush, everything should be incredibly better.
That's right.
No, that's not the case. And so now this person is saying what? Well, I understand. I made those decisions then, but now I want to go err on the other side and be extremely aggressive. Okay, the question then becomes, is now the right time to be making those decisions, or are you going to find yourself in 6 months from now? It's the chasing game.
That's right. And really, one of the things that we, really try to hit home with the behavioral finance presentation that we do is to not let the noise impact the decisions that you're making, right? Like, the idea is, number one, work with a professional that is going to remove emotion from the equation here, right? So they're not emotionally tied to your money like you might be. So they're going to be able to make decisions based on the plan and objectives that you put forth. And unless your objectives change, the plan shouldn't really change either. Mm-hmm. And so I always use the example of, as I'm approaching retirement, if the idea is to peel off a portion of my equities and put them into more safe money vehicles, be it fixed income or fixed annuities or fixed index annuities. That we should remain true to that plan, kind of regardless of what the market is doing. Just because the market is up 20% doesn't mean we should necessarily keep riding that wave. And just because the market is maybe down doesn't mean we should postpone that decision, because those could have long-term impacts on our ability to retire.
Or that decision at that time is a bad one. It's not. No, that's not the point at all. I love this. Let's make a plan. Let's stick to the plan. Now, unless your objectives change, there's no reason to change the plan. Let's commit to that. Okay, moving on from there. Let's talk a little bit about some biases and aversions that in particular that you see and or that you present to. Are there some that you're seeing today? I'd say more timely than others.
Yeah, I mean, I think the first one kind of lends itself directly to what we were just talking about, right? And it's the anchor bias. And so the anchor bias is really our need to put value on something. So I always share this story with the audience when I present, and that's, okay, let's pretend I have a formal event to go to, and I'm going to buy a pair of shoes. Okay, so I set my budget for this pair of shoes at $200. Okay, I go to the first store and I find a pair of shoes. They're nice brown shoes, and they're going to work for me, and they're priced at $199. So I realize they're at the top of my budget, right? Let me keep looking. Now I go to the next store, and I also find a pair of shoes for $199, and they're also brown, and they work, and they're going to work for my formal event, but this pair of shoes is marked down from $500. So all of a sudden, my perceived value of the second pair of shoes is much higher than the pair of shoes that was not marked down. And so I'm not only spending $199, I'm saving $300. So of course I'm going to buy the second pair of shoes versus the first pair of shoes. Now, how does that relate to like what's happening now? Well, let's look at interest rates, right? So today you can get, a 5-year MYGA upwards of 6%. In 6 months from now, let's just say that the rate for a 5-year MYGA is at 5.5. If your anchor is 6, and now it's at 5.5, is 5.5 a bad deal?
Right.
Or 18 months ago, 2 years ago, 3% might have been a good rate on a 5-year MYGA. So if 3% is my anchor, then 4.5 might seem like a really, really good deal. And so the whole idea is the last time that we saw 5-year MYGA rates above 5%, I mean, you'd have to go all the way back to late 2008, early 2009.
Yeah, let me interject this real quick. Hold on to your thought. Nick tells this story all the time, how it was one of the companies came out with a 5-year guaranteed for 3.3. And he wasn't in the business maybe a year and a half. And I'm like, Nick, this is the greatest deal. You have to call you have to get a hold of every single live insurance agent you possibly can and tell them about this incredible rate. And here we are today. Right. And it was the best deal at the time. And now, as we sit here today, to your point, it's like 3.3, geez.
It doesn't sound that great.
And how short of memory we do have, because we were sitting with less than those rates within the last 24 months.
Right. If somebody at let's say beginning of 2009 was the last time you could get a 5% MYGA rate for a 5-year term, if somebody didn't make the move then they waited more than a decade to see those rates come back. The idea is if somebody went into, let's say, a 3-year MYGA back in 2009, and then in 2012 it renewed, they waited for more than a decade before they could get that same 5% rate. The idea is the interest rates will change. The value of something is different from day to day, from year to year. And it's less about, is this a good deal? Is this not a good deal? And it's more about, does this help me solve my problem, right? Does this meet my objectives, and does this work in accordance with the plan? And if it does those things, then perhaps it's a good deal.
Mm-hmm. And what do we call this bias?
That's the anchor bias.
Okay. All right. Are we moving on to the next one?
Sure.
What do we have next?
Well, let's talk about ambiguity aversion. Okay. So in the presentation that I give, one of the things that we talk about is one of the fastest growing cable TV channels, streaming channels out there is actually the Hallmark Channel, right?
Interesting.
And the reason the Hallmark Channel is really growing.
I'm not sure I could have ever guessed that. I would have gone down my
Well-
my visual Rolodex of the TV guide. You know what I'm saying?
Right.
I wouldn't have got to Hallmark, but okay.
It's one of the fastest growing out there. If we think of other popular channels or maybe fast growing channels out there, it's kind of a similar story. If you think like HGTV, channels like that, what the Hallmark Channel does for us is it gives us this predictable recipe, right? Every time you tune into a Hallmark movie, one of the things that you're going to see is you're going to meet some people, right? They're going to be generally good people, but inevitably they're going to encounter some conflict throughout the movie, and then they're going to overcome that conflict. They're going to fall in love, and it's going to be this fairy tale ending. You know, every time you tune into a Hallmark movie that these people that you met at the beginning of the movie are going to be better off at the end of the movie than when you first met them. Mm-hmm. Every time. And it's that predictable recipe that keeps people coming back. And so when we talk about, I have the opportunity to wholesale index annuities, and we talk about index annuities, there's a wide range of reasons why somebody might buy or somebody might position an index annuity. And one of the ways that I really like to kind of sum it up is we'd like to provide more predictable outcomes to clients' retirements through more consistency of returns.
I like that. You know what? Maybe not exact. You're going to feel better at the end of this. At least that's the objective, right?
Right. And so what the ambiguity aversion suggests is that, I'll give you an example here, Scott. If we were to have two buckets of balls, right? There's red and black balls in each bucket. The first bucket has 100 balls in it, 50 red and 50 black, okay? The second bucket has 100 balls in it, but we don't know how many red balls are in that bucket or how many black balls are in that bucket. If I were to tell you, okay, I'll pay you $100, fictional money, of course, to successfully pull out a red ball, which bucket are you going to pull from? Bucket number one that has 50 red and 50 black, or bucket number two where we don't know how many red or how many black balls?
Probably the one with 50-50.
Right. Would your answer change if it was, if I asked you to pull out a black ball instead of a red ball?
No.
No, right? And we're always going to move more towards the more predictable outcome. That's ingrained in us, and that's a bias that we have. And so when somebody's faced with, you can get a guaranteed 6% return, right? Every uncertainty or every time you move away from that guaranteed return is going to cause a little bit more of that ambiguity aversion to flare up in people.
Interesting.
Yeah.
It's just the way we're wired.
And then, I think kind of goes hand in hand with that one is the myopic loss aversion. And the myopic loss aversion is really the idea that people hate losses twice as much as they like gains. Okay, so the anxiety, the angst that we feel when it comes to money that we lose is twice as much as compared to the euphoria, the joy that we feel for money that we gain. And I'll kind of share this with you with an example. So if I were to say, again, fictional money, of course, but I'm going to give you 100% chance to win $3,000, or I'm going to give you an 80% chance to win $4,000, and a 20% chance that you win nothing. Which one are you gonna choose?
I'll take the $3,000.
Take the guaranteed $3,000, right? Even though 80% chance to win 80%, those are really good odds, right?
So I guess then becomes the question, how, and everybody maybe has their number, right? If it was an 80% chance of winning $6,000, would you take that?
I mean, statistically, yes.
Most people are going to take, do you think statistically, most people would take the 100% chance of 3,000, or as I raise the level of opportunity based on relative risk, then I will tend to take the riskier option.
Yeah, and that goes into prospect theory, but you're spot on here, Scott. Like as you raise their level of opportunity versus risk, I mean, people will tend to then kind of move towards the more risky option. However, 100% chance to win $3,000, a lot of people are going to still take the guaranteed $3,000.
See, these are really, really good tests for an individual, an advisor, to profile their client, to really develop what kind of person I'm working with here.
That's right.
And what guardrails, right, should I be putting in place to help you manage towards your long-term goals? That's kind of where my mind goes. And then your previous example to that, I'd say with the red balls and the black balls, right, you have one bucket that's 50-50, the one of unknown. But if I was to say, which bucket would you pick? I'm going to give you $100 of hypothetical money with the bucket of 50-50 to pull a red. Or if you choose the other bucket and I give you, $200, but only 25% are red, which one would you take? It's a gauge of how risky. Where does this person's psychological balance, sway in terms of risk and reward?
Yeah, and I think people's perceived risk tolerance also shifts depending on the market that we've just experienced, right? I think people viewed themselves as a lot more aggressive on the risk spectrum at the end of 2020, beginning of 2021 than people might view themselves now. After we just had a decrease in 2022 and sort of kind of a flat 2023 thus far.
Yeah, that's a great point. Which I guess the needle moves depending on the economic conditions that I'm in, the environment, what things look like at my employment, what geopolitical issues are at play, everything going around is also, it's a lot easier to de-risk today with the interest rate environment, because if I can get 5 or 6 without really taking very, very little risk, or let's call it proverbially none at all, well, that's a pretty good rate. Maybe I'll just do that. So the environment also maybe tends and plays into my appetite for taking risk or de-risking.
That's right. That's right. And, as we kind of go back to this myopic loss aversion here, the whole, one of the things I want to come back to is, if I were to flip this around and I were to say, Scott, let's say you have a 100% chance to lose $3,000, but an 80% chance to lose $4,000, and then a 20% chance that you'd lose nothing, which one would you choose? Would you take the guaranteed 100% chance you're going to lose $3,000?
I'd take the 0.
You'd take the 80% chance you're going to lose $4,000 with the 20% chance you lose 0.
Is there an option to lose nothing? I want that one.
But the idea is 92% of the people actually choose the 80% chance to lose $4,000. And the whole idea is on the flip side, most people choose option 1. They're going to take the sure thing, and they're going to take the gain of $3,000.
The bird and the hen.
Right? But on the other side, when it comes to losing money, they're gonna risk it, and that illustrates how we will go to the end of the earth to not realize a loss.
It's also interesting how people just consider themselves like, okay, well, I have a 20% chance of keeping the money, of not having any loss.
Right.
So it's going to be the person next to me that's going to be the 80%.
Sure.
It's not going to be me.
Right.
I'm going
Right.
to be the one not in that. And we deal with that. Let me use another example in our on professional life and long-term care planning. We always go through this exercise and we say, okay, now that we all know the foundational statistics, 50% of you age 65 and over are going to need some form of long-term care. Go ahead and raise your hand if you think you're going to be one of those 50. Who raises their hand? Nobody.
Right.
And then I say, okay, fair enough. Let me ask you this question. Who in this room is sitting next to the person that thinks they're going to need care? Everybody's hand goes up, right? It's not going to be me. It's not going to be me. I'm going to be the 20%. And to that point, it's like, how foolish are we with our own money?
Yeah. I mean, it's so important that we, number one, work with a financial advisor, right? Work with somebody else, and set the plan in place. And mostly, like, don't make decisions in the heat of the moment, right? Don't make a decision after the market had just ripped up for the 12th straight year, right? That decision should have been made of when are we going to start transitioning to more safe money, more conservative options. That probably should have been made, 5 years ago, 10 years ago, as we're laying out our plan. And then we stick to that plan, kind of regardless of what's happening around us, and not in the heat of the moment.
Mm-hmm. That's great advice.
Yeah, and I think that that sums up, really what we try to hone in on with behavioral finance.
Is there anything else that we should cover today, or we would be remiss?
If I could just squeeze in, one more bias here, one that I really love to talk about, it's the herding bias.
With a D, herding.
Herding.
Yeah, okay.
And what I wanted to talk about here with that is this was actually conducted on a college campus where Solomon Ash, he interviewed 100 male students.
That's concerning.
Right.
Alone.
Right.
Okay.
So it was 100.
Just so we're clear about that.
It was 100 male students, and what he did is he put up a line. Right. This line was over here, and then over to the right were 3 other lines of different lengths, varying lengths. Right. And he said, what line is closest in length to this outlier line here, right? And it was apparent there were 3 lines, 1, 2, and 3, and it was really apparent that it was line 2, right? And when he asked the male students this question, when he surveyed them one-on-one, 99 out of 100 male students got this question, right? They said line 2 was most similar in length to the outlier line here. Why, when you look at the illustration, like why it wasn't 100 out of 100 male students, I don't know, but I could say it was 100 male students on a college campus, and that might explain something, right?
Yeah.
But then what he did is he asked the same question, had 100 male test subjects, but he put them in a room, right? And there were 7 planted individuals in the room. And the planted individuals were instructed to not answer with line 2, but instead answer with line 3, which to all of us was apparent that was not the line that was most similar in length to the outlier line. And it was person number 1, the planted individual said, line 3. Second person said line 3. Third person said line 3. Fourth person said line 3, until it got all the way around to the test subject. And 70% of the time, the test subject said line 3.
Wow.
And that is the herding bias, the need for all of us to follow the herd. And we can look, you grew up learning about, the Great Depression in school, and there was an element of herding behavior there, right? Cryptocurrency had an element of herding behavior. Even the recent bank crisis that we had earlier this year had an element of herding behavior. But it was with a colleague that, actually kind of drew my attention to, really more of I feel like an endearing testimony regarding the herding bias. And it's really when you're sitting down with your financial advisor, the financial advisor is sitting down with their client, and the client is, marking down who their beneficiaries are, who they'd like to leave their money to. We really need to remember that those individuals in that beneficiary section are this client's herd. And there is an element of herding behavior where I think that, we oftentimes overlook the next generation, right? Or this person's herd that's part of their beneficiary group. And I think that there's a big opportunity there to connect with additional individuals that the client might have relationships with and extend, financial advice to them.
Okay, as we look towards wrapping up here, I'm curious, what books have you found that are worth reading for someone who's investing in this topic and wants to learn more? Or what other resources exist that you've found that are meaningful for people to tap into?
The greatest resource for me, well, let's first start with a book that I really like. It's The Behavioral Investor. And I'd be hard-pressed to remember the author here at this moment. But The Behavioral Investor is one that I've read that I found very insightful. I think one of the things that I really enjoy about behavioral finance is I like to share stories and analogies and kind of relate some of these topics back to a topical story that I might have, where some of the books kind of they can dive into the weeds a little bit, and so it's easy to kind of get lost in some of the details that exist here with behavioral finance.
That's what I found. A lot of them just get very textbook. Not that that's not appropriate, but to your point, to be able to then equate that knowledge and information into more of a layman form with a specific life examples. I mean, that's how people remember this information.
That's right. And I find I'm an accredited behavioral finance professional from College for Financial Planning. That was an excellent resource here for me to go through that course. And
what does that curriculum look like?
It took me about 4 to 8 weeks of study material. That's probably an hour to 2 hours a day, 5 days a week before I took the test, completed the test, and now I'm an accredited behavioral finance professional.
And worthwhile?
I found it to be extremely worthwhile.
Good.
This was a topic that I had been covering for a number of years. And when that designation became available for College for Financial Planning, I immediately signed up for it. And to be honest with you, Scott, I thought that I was going to breeze through this exam. And I was very surprised at how in-depth this goes and how much deeper that you can really dive into this topic. And for me, I feel like I'm never going to stop kind of pulling back the layers of the onion here on this topic. And I learned something new all the time. And, it's because I have this accreditation. I mean, I'm by no means an expert on this topic. I'm still a student of this topic and probably always will be.
We should always be.
That's right.
A lifelong commitment to learning and sharpening the saw. Good for you. I appreciate that. All right, anything else? How do people reach out to you?
Well, you can give me a call. First of all, you can email me at anizzi@gilico.com, or you can always give me a call at 515-975-4936.
Outstanding. Thank you for coming in. Appreciate the time.
Been a pleasure.
Cheers.
Cheers.
Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.